Hello, good morning. Hope everyone is doing well wherever you are in the world. My name is Steven Snider, and I want to welcome you to our second session of oiConference, Developments in Sustainability and Finance. And the reason we're calling it oiConference is because it is a virtual session, and one of our partners is Oikos International, which is a student-led group that organizes events just like this around the world on sustainability in finance and management. And I am very, very excited to have over 100 people on this call listening to our discussion about sustainability in Finance 101. We have a really, really great speaker here to talk. But before I introduce him, I do want to do a little bit of housekeeping. So I'm going to start a poll right now where you can tell us where you're calling in from, and you know, pick the area that's closest to where you are. Unfortunately, we can't include every location of the world, but let us know what your background is, how much you know about sustainable finance. Give us a good idea of what's going on. Like I said, my name is Steven Snider. I am a sustainability master's student at Harvard University. And I have had the privilege of working for and learning from Professor Carlos Vargas, who is here. He is going to give a really great presentation on what sustainable finance is, what it means, and what are some developments in the industry. He gave a really great presentation last year on the topic, and we brought him back so that we could have him share. So just a few more things. There will be a link that we will be sharing in the chat. My co-host Oliver, would you please share that? This link is how you will be able to ask questions of our speaker. There's a lot of you, so we want to make it as democratic as possible, so you can upvote the questions that you want to get answered. And additionally, if there's any disruption in the chat, Oliver and I will be kicking people out, as there is a tendency for these chats to get Zoom bombed and disruptive people to join. That all being said, feel free to chat, share your LinkedIn profiles or ways that people can network with you in the chat. And yeah, I'm really looking forward to this. So in the poll, let's take a look at where everybody's coming from. I'm sharing the results with you now. As to be expected, the majority of you are here in the East Coast. I'm currently in Boston, but it looks like there's a lot of people in Europe, and I'm really impressed to see people joining from Central and South America, from Asia. Majority of people seem to be graduates or PhD students, and we have a general knowledge of the topic, with some people knowing a lot more and working in this space. So with that being said, I'd like to hand it over to Professor Dr. Carlos Vargas, who will give us a great presentation. And yeah, I'll hand it over to you.
Well, thank you so much, Steven. And yes, well, I'm very happy also to see all this diversity. It sounds amazing, and I think it's also very nice to be able to share all of this with people all over the world, and perhaps to have some conversation at the end of the presentation. So I'll try to keep it brief so that we have enough time for Q&A in the end. Perhaps before I start with the intro to sustainable finance, I'll tell you a little bit about myself. I met Steven because we've been working together at a class at Harvard on sustainable finance for the last couple of years, and that's how we've been joining forces for this professional topic that actually has a lot to offer and has been very, very interestingly evolving in the last couple of years. And on the other side, I was acquainted also to Oikos a couple years ago because they actually sponsored partially my PhD. When I was doing my PhD a couple years ago, sustainability is one big area of interest of oikos, and they were interested in sponsoring me on doing that, which actually was amazing. And I was very, very happy to be part of this amazing organization, and also being able to see how actually they do engage in all of these topics, which actually are very, very interesting, but also that I was able to be part of this big community of people all over the world sharing this common interest, which is also great. So thank you so much for letting me doing this. Let me share my screen so I can start with what I have for you today. As mentioned, of course, we have not enough time to talk about everything about sustainable finance, but just to give you a brief idea of what it is, where it's at the moment, why is it relevant, and what can we expect for the future. So how did we get there? Probably first way that we can start talking about sustainable finance is talking about a little bit of history, perhaps not going that far back, but just a little bit closer to our day, and mention how this has been evolved in different ways for the last couple of decades. Basically, back in the 90s, we started having some interest in these topics, and we started to see that there was some need to actually redefine the way we do finance. There was a shared interest amongst different organizations, and we see how all of this has been evolved. Of course, you might be knowing some of these groups that we see here. And basically, we started to share an interest. It was perhaps a niche, as some people call it sometimes. And we started to think that we should be doing some things in a different way. Of course, in more recent years, the interest has been evolving, and now we have actually ways to do it. And we have reporting systems, frameworks, the European Union taxonomy, for example, on sustainable activities that actually tell us a little bit more on not only the intention of doing sustainable finance, but also on how to do it, which is actually a very, very interesting. All of this comes from different people that have, in my perception, have been instrumental in actually having some of these actually take shape in recent years. One of them is Andrew Carnegie, which actually was one of the founding fathers of philanthropy. He was an American industrialist in the 1800s that basically started to define how philanthropy should take shape. But as we will mention, philanthropy is not necessarily sustainable finance, because sustainable finance does have two components. It has the financial part of it, but it also has the intentional impact on the other side. And philanthropy, on one hand, only has the impact intentionality, and not necessarily has the financial aspect to it. So it's kind of a beginning, but it actually, it's not quite there yet. And then we have this other guy that you all might be very, very familiar with, which actually is probably the founding father, in this case, of modern finance. And this guy was pretty much on the other side of what Carnegie was proposing, and basically was saying 30 years ago, probably a little bit more, back in the 70s, it's almost 50 years now, not even. So anyway, some decades ago, this guy was proposing that actually finance should be the guiding side of the economy, that we should always care for return, and actually companies shouldn't have any other intention than creating profit. As we know today, 50 years past, and we understand that actually is not the best approach also. Why? Because finance also has a very, very interesting things that we can consider for designing political and economic systems, for example. But we also have seen how it has failed in a couple of times in the very, very recent history in the last 20 years, several times, which actually is very impressive, and we'll talk about these too. So some time after, these other two guys came into the picture, and we started to see how we could balance both of those extremes. Philanthropy on one side, talking about impact, but also finance on the other side, talking about return. And then these two people here, David Rockefeller, that was a very, very relevant philanthropist that was interested in the topic of impact investment, actually helped to coin that particular term, impact investment. Judith Rudin, that was the president of the Rockefeller Foundation, aligned to that, basically started to shape the concepts on how impact investments should be defined. What we will see is that eventually all of these will have different names, but what we are looking for is precisely that, impact. That's what we are doing. And then came along this other guy, some of you also might know him, he's Larry Fink. He's basically one of the most successful bankers in recent history. He basically manages the money of a lot of people, that's about $7 trillion. That, for those of you that are in other places, it's many, many zeros into the amount of money that he's managing. He's the director of BlackRock, the biggest money manager in the world. And basically what he started to say in recent years, actually a couple years back only, he started to send letters to his stakeholders saying that we should care about social responsibility. Companies do have to care about return, yes, but they do have to also be part of their social responsibilities, and that's a big step. Why? Because now it actually becomes something mainstream, and we're not talking about niche anymore. We're talking about something that it's becoming a new norm, and that's something that actually is very, very relevant for us. This only a couple months ago, the Business Roundtable started to say that the purpose of a corporation should be to promote an economy that serves all Americans. This is, again, one big, big step. Why? Well, because this might be just a little piece in the news saying that a group of businessmen or business people are actually willing to do something about their purpose and care about going beyond producing return only. But in reality, what these mean is that this group actually represents what we see here in the screen. And this is what this group tells about themselves. So I'm just trusting this is true, but it's actually very relevant when we talk about companies that employ in total more than 15 million people, that contribute to healthcare and retirement with over tens of millions of dollars, that make over $8 billion in charitable contributions, that have a lot of money devoted to research and development, that also are including a lot of impact into other businesses that are also small and medium, and not only these big corporations that are talking about this. And they still do their part, which is providing dividends to their shareholders, which actually is expected because it's part of what companies do. But I think one person that also might be relevant to getting us to where we are today is actually this girl here that seems a little bit angry in this picture. So why don't we try with this one better? And that's Greta Thunberg, that I'm quite sure everybody here will know who she is by now, because she actually has done something very, very important that perhaps we couldn't do better than her, any of us before. And it's actually letting people notice that we should do something. And basically what she did is she striked for climate, and she started to talk to politicians with a very, very hard message that it's actually very direct, and it's you should do something and we should do it right now. It's not that we can wait and we can just start doing our part to include the environment into our day-to-day life. We have to start now. And actually, she's also putting responsibility on politicians, and it should be put in all of us, not only politicians, about the future of new generations. And that's actually something very, very important because she's only 17 years old, and she started when she was even a little bit younger. But the message is very strong, and I don't think anybody actually haven't heard or doesn't know what this message particularly mean. What happens is that sometimes we do choose to ignore what is going on. But that sense of urgency also was put into the picture, and I think that's why it's very relevant that we hear about it. Why is it important? Well, as I was saying, it is a very relevant topic today. We hear about it everywhere in the news. We actually have it in our day-to-day conversations. If you are in the finance world, you start to hear it more as we speak. But it does have many names, and the fact that it has many names sometimes blends a little bit the message, and it's a little bit difficult to identify how relevant it has become. But what I have here is just some examples of different names and shapes that it takes. But what we see is that we do have a new interpretation of finance. We have a new understanding of what it should be. And somehow all of these different names in the end tend towards the same thing. As I was mentioning, finance and impact, they have been two forces pushing towards different extremes of the same situation. When we try to balance them and actually put them together, and we actually care about social return, but we also do care about financial return, it is possible to do it. We have great examples of these, and that's actually what we call sustainable finance. With, again, many, many more names, but that will be very common that we do. Opposing forces, as we've been mentioning, but it doesn't mean that it cannot be done jointly. What we do observe in many cases is that we have some companies or organizations that basically focus into one of these two objectives first. If we have funds, for example, that have impact first, if they make return or they don't, that's actually circumstantial because their mandate establishes that they actually go very strongly for impact. In a way, that's something that would tend a little bit more towards philanthropy and not necessarily towards business activity. But we do have on the other side other organizations, funds, money managers, etc., that also go for return first, but they do care about the impact, sorry. So if we have that particular situation, well, what we find is that actually some of them, they do perform very well in actually both of them. And that's actually great examples that we can use to actually say that these pay back. And it's actually easy to make money while also having a positive impact, which is actually a better situation than just doing one of the two. Which actually put us in the situation that we have the possibility of have this being done jointly and having impact and return as priorities for these business activities. And it's actually when we find sustainable finance. Why? Because actually the fact that these activities are producing a positive financial return actually helps sustain the overall maintenance of the activity over time. But the fact that the positive impact is also kept, it does favor the original mandate of what it's done. All of these that I have mentioned, we can also see it in numbers. There's many, many studies today, and I'm very happy to see that actually. But in this case, we're talking about some numbers from GIN that they actually focus into gathering people in impact investment and getting very good data sets and having very, very interesting projects on how to actually make impact investment happen. And what we see here is that when they sampled some of their data set and they actually wanted to see whether or not their investments were returning better than the market or not, done properly, because it also has to be adjusted by the risk that these investments entail. We basically see that most of the investments that were sampled, in this case, it was a small sample, 266 investments, they actually find out that 66% of them, most of them actually were performing according to the market, not significantly better, not worse even. And that's actually good news, because if we see that we are actually having a positive impact, but on top of that, we also have a good return, that it's actually according to what the market would expect from it. Well, if you have otherwise two investments and one has positive impact, the other doesn't, but they return the same, one normal person would try to do a little bit more. I mean, eventually the risk is the same, the return is the same, but you do have a positive impact. You have value added into those sort of investments. So easy, you just go for the one that also offers positive impact, unless you really choose to ignore it, or you have other drivers or something like that. Anyway, not only that was found in the study, also the green area that we show in this graph shows us that some of these returns are close to that market return, but slightly lower, which is actually letting a little bit of the potential return on the table, yes, but still according to market, just very, very close to what the market would expect. And this is not perfect science, it's actually great news, because it basically means that some of them are still on the same scope, on the same range of returns. It's just that they underperform slightly to the market. Still great news. Why? Because now we are talking about 85% of those investments on aggregate are actually returning either market level or very close to market level, which is actually great news. And only 15% of those investments sampled are the ones that are below market return, and they are looking for capital preservation. Excuse me for the typo there. But basically what this means is that we are on the right track. If we actually sample the whole market and we see all those instruments that actually perform well over market, online to the market, or slightly lower to the market, we still would find some of them that would underperform. It's just normal in a universe of investment alternatives that we would find some returns that would be over, in line, or under. It's just expected that we have that. But the results that we see here are amazing. They're overwhelmingly, surprisingly positive, and that's something that we can say about financial returns in this world of sustainable finance, which is, in my opinion, great news. We have on the other side the opposite, scene stocks, stuff that we actually know for sure that they do have a negative impact. Tobacco, alcohol, guns are typical examples of these. And they are typically believed that they overperform other investments. And what we find in other studies, which is actually very interesting, is that it does happen sometimes. But it also depends on how you measure these investments and the returns that they offer, and how you adjust the risk that you're taking taking these kinds of investments. So not necessarily it means that you have better returns by investing in those negative impacts. But of course, if you want to measure some benefit into doing it, you can find ways to observe it as well, which is actually the case with any investment. But it's not that always returns better, which is a typical misbelief in this case. Who is interested about doing this? Well, we have some other data from Jin in this case, And what we see here is that virtually everybody is thinking about sustainable finance today. We do have some special groups of interest, obviously NGOs, religious institutions, some other people might be interested in doing this kind of thing because they already have the mandate to go for impact in a way or another. However, we do see family offices, fund managers, and other people that are just getting on that track. And that's just the normal evolution that we would expect with the new understanding of finance that we see, for example, here. Impact investing, as we were mentioning, is not a substitute for philanthropy. It does complement it, and it's a new world of opportunities. It's very interesting to see what it is in reality, because as I was mentioning at the beginning of this talk, it actually came from philanthropy. So even though sustainable finance, it's not only philanthropy, but also finance, but actually the place where they both meet in a way. When we talk about impact investment, the components of philanthropy are going to be very, very relevant, because it does come from there, and some of the interpretations might come easier from coming from philanthropy, just because it was coined from philanthropy. Sustainable investments are basically many things. They take different forms and shapes. They have different names, as we were mentioning. They have different characteristics for different asset classes, but it actually is happening as we speak. And now we have the possibility to actually measure those elements of sustainability in many, many ways today, but also in way better forms than we had before. Some other examples, venture philanthropy, for example, it does take some elements of venture capital, which is also a very specific area of sustainable, of finance in general. And they do incorporate those elements of venture capital with those principles of sustainability and sustainable finance in particular. And they find ways to actually undertake the higher risk of venture capital into having the positive intentionality of philanthropic activities. So very, very interesting concept, for example, also blending all of these understandings. We have philanthropic capitalism, effective altruism, and catalyst capital, for example, as great examples on these. And we could talk actually a couple hours about these topics because they're very, very interesting. But then in reality, the important part here is how do we make it happen? And although we only have very, very short time to talk about these, I think one of the great advancements that we have done in this area of sustainable finance is actually defining some criteria for trying to measure that impact. One very popular one is ESG. ESG criteria is very, very popular in the financial world today. Why? Because now we have a lot of information available. We actually have suppliers of information that are able to put together some very good data sets that actually help us understand the impacts of some of these elements into assets and actually corporations and many, many other things, countries, even products, etc. And we have some examples here. Why is it called ESG? It's self-explanatory, environmental, social, and governance elements. But we see here some examples of what they entail. It's actually many, many other things. So it's very, very interesting how it's has been taking shape. What basically ESG means is that they are actually measuring some of these impacts, and sometimes it's compared amongst peers with comparable companies, for example, when we are analyzing assets, but it can also be used for many other purposes of analysis. What results do we see on trying to do this additional effort into incorporating these elements into financial analysis? We do see that there's some return, that it's actually exceeding other sort of investments. Most of it is actually coming to this style of factors, which is actually great news again. Stocks with higher ESG ratings tend to have lower stock-specific risk. Then again, one thing is to increase performance, better return, but then another thing is to reduce volatility, reducing risk. So having both in the same trend, it's actually great because we increase return with reduced risk. We're just in the best situation possible. And this can also lead to better returns. That's just expected based on what we mentioned. But there's other ways also to approach sustainability in finance. We have seen this one gaining a lot of relevance in recent years, and it's basically the most common framework that we see today. And SDGs, Sustainable Development Goals, basically means that we are aligning to a framework that was designed in this case by the United Nations and telling us about the priorities that you should take into consideration, how to approach them, or how to also communicate them once you have defined your programs or your impacts. In this case, this has been a very, very interesting effort. It's become very popular. It's very easy to read. We can even find it sometimes in very, very diverse things, even like study programs. You can find the different scopes or different goals that are approached towards their activities. For asset classes, this has been a goal. It's been very, very easy for them to actually approach their communication on impacts in such a way. My only criticism to this is that it's a very, very nice approach, but still not comprehensive. We need a little bit more, and we have to go a little bit deeper and find also other activities that we need to include into our priorities. And that's when other frameworks have started to develop. So, for example, the European Union taxonomy that we have mentioned. And then there's other people that have different ways to understand this. For example, Kate Raworth has a very, very interesting theory about the Doughnut, and she mentions how we as individuals, society, markets, and environment are part of concentric circles that we cannot understand our function or our activity or our development or any things that we do without understanding that we are part of a bigger reality, that we are part of it. How it can be done, also strategies have been evolving very, very successfully in recent years. And this is almost to conclude the talk today. Well, basically, we have been from the moment that we started to consider that some things could be bad, which is the easiest thing to do, and we started to exclude negative impacts, which is easy enough to do, and that was the first approach. But that's not the whole thing that we can do. We can also go and do the completely opposite thing, which is actually to look for the champions of different positive impacts that we need to promote. And that was best in class, for example. Once we started to do that, we needed more information, more analysis was incorporated, and that was a very, very interesting situation because it started to evolve to a world of new possibilities. And then some other things started to happening, for example, engagement of stakeholders, and actually people started to advocate for their own interest within companies, and not only trying to understand what companies were doing and feeling responsible for it, actually voting upon it and actually pushing towards a positive change. Some other things also were allowed, for example, thematic investment, now being able not only to understand that these measurements can be focused or analyzed even at the beginning, but also trying to approach different specific goals according to preferences, which is great. And actually being able right now to actually support companies that reduce child labor or that promote women's rights or that support specific geographic areas in the world. This kind of thing is possible now towards financial analysis and information availability, and that's actually a great thing. And then impact investing that we have actually talked about very much during this talk, and the two extremes in between here, traditional investments and philanthropy that are actually where all of this is falling in between. But many other ways to do it, new strategies are emerging as we speak. For example, blended finance, which is an evolvement of all those public-private partnerships, PPPs, that we have before, or public partnership, public-private associations. PPAs was another name that it had a couple decades ago, that actually allows for having different participants, private and public, financing, designing, and supporting bigger projects that need to be scoped in a different way, but also incorporate some elements that we see here, venture philanthropy, etc. So what we could say here, which is actually, I think, great news of what we have to hear about an introduction to this topic, positive influence. There's mixed results that we can find on different studies that we have, but they do tend to be positive, which is great news because it means that it's actually possible to actually look for better return profiles, but actually adjusting for adequate risk. And in reality, also when we talk about risk, what we find in other studies is that in many cases, also risk is reduced towards sustainability. We don't know the causality of it. We don't know if it's because companies are sustainable that they have risk, or it's because they have lower risk that they're sustainable. But we do see that there is some correlation, and that's great. That's something that it's actually getting us into a good place into trying to promote this kind of activity. And if that is the case, and we can have positive results and less risk, of course, this aligns to the interest of investors. And if it's in the best interest of investors, it just needs to be done. New challenges that we see today, well, I think it's not even necessary to mention the situation that we have. I heard the previous speaker was talking about this, and it's something that, of course, we cannot ignore. This situation with health issues, coronavirus, lockdowns, and all of these, it's obviously impacting a lot of us today. If you think about it, the health situation about coronavirus is actually touching a lot of people. Thousands of people, hundreds of thousands of people actually today. But what we cannot leave behind is to say that actually, if we consider the impacts that this has had in the economy, it's actually touching not hundreds of thousands of people. It's actually touching pretty much everybody in the world. Millions of people are affected by the secondary effects resulting from all of this. Well, my personal opinion, and we still are early to say, is that eventually this will result also in some learning lessons, and one of them will be resilience. I do believe that those companies that have invested into having positive impacts in different areas, they will also come out to be more resilient than otherwise more traditional companies. But we will have to wait a little bit for more results to actually see how this is shaping. But I do believe sustainable finance in this kind of situation only helps, because you're starting to build a stronger business activity, that it's more comprehensive, that it's more responsible. It does have a way to actually result in a positive risk reduction for companies. For my part of just monopolizing the talk, that's basically what I have now. But I don't know if anybody has questions or how we could manage this. But I'm here to answer any of your questions and to share a little bit more in case anybody's interested in anything in particular.
Thank you so much, Professor Vargas. That was a really great presentation. The chat has been going wild. Our Slido Q&A application has also have a ton of questions. And so I can tell that this has been a very encouraging and enlightening speech. As we kick off the Q&A, I just want to start by asking you, you mentioned Greta Thunberg, oikos International. This sort of conversation here are ways that people can get involved and are showing that there needs to be done. What are some ideas that you have of how people on this chat can follow up with sustainable finance and get deeper involved personally?
One that comes to mind very fast was precisely oikos. One of the reasons that I was interested about joining oikos a couple years ago was precisely because of their interest into developing a new curriculum related to sustainable finance. Why? Because I think, at least for me, in my own side of the picture, on my 2 cents, what I can offer to all of these topic is actually to help build knowledge, communicate it, and actually help educate future generations of people that are interested into this topic. So I think some of these efforts have to come from there. For the different people that I see here, as you were mentioning, there is a lot of PhD students here. That's actually great news. It's something awesome to see, because right now I think what we need is more research as well. We need more basis to be actually to support this idea that the new paradigm of finance has to be sustainable. Why? Because we first believe it was something different, and as we mentioned, it came all the way from Friedman, actually making the whole economy faceless and looking for returns no matter what, and actually pushing towards neoliberalism that ended up costing a lot of money to all of us. There's nobody in this world that hasn't paid the price of all of these choices that we took some decades ago. The new paradigm has to be sustainable finance. Why? Because we do have to return. It's not even new. We also were trying to ignore that those companies were responsible for other things. We have to remember that. We have to remember that before, more regional companies were more in touch with their own communities. Well, right now we have huge corporations that are multinational, and they're basically located wherever it makes more sense for them tax-wise. But it doesn't mean that those companies can ignore the responsibility towards society and actually their role towards society. I think we have great examples today of some of those huge corporations now looking back and actually saying we need to do our part and we have to give something back with this particular situation of coronavirus. I think that has been very interesting examples of leading towards positive change in this regard. Companies choosing to do disposable equipment for sanitary purposes. Some other companies building respiratories, just turning the factories into something that it's just needed, but it's also urgent at this particular time. That's something that we will start to see more and more, but not only on special situations or catastrophic situations as we have this particular day, but also as their own day-to-day activity on how they just have to assume their own role with society. But we do start to see more of this, and I'm pretty sure it's the new way that not only companies will understand it, but also society will push toward that. And in the end, it will only benefit all of us.
Thank you. Yeah, it's really interesting to see with everything developing around the pandemic and climate change, to see how conversations are really happening around the world to push us towards that. We can't go back to that prior world that we were in before this crisis has started. And to that point, I'm going to combine two questions. They're the first and third most voted questions, so I know they're on top of mind. But how can we use sustainable finance to assist with the current pandemic and help solve climate change?
Well, I think one good example is precisely those activities that have been just reaction of the situation that we have today. But also, I think one important part that we see precisely with events like this is going more towards more virtual interactions. We precisely had all of this technology with us for probably 10 years or even 20 years. We've had all of this possibility of doing the kind of interaction that we have today, being able to have an amazing conference with people from all over the world, just sharing thoughts and having this experience by using a laptop or a mobile device. This kind of thing, it's actually a paradigm change. I also think in other kind of activities, human interaction, commercial activities, impact, etc., this is what we will see more and more. And we will see how sometimes this that we were a little bit afraid of doing before, and we actually were able to transition so fast, even in a couple of weeks for universities, for corporations. We'll see how it will actually allow for a better knowledge sharing, which I think is a great thing, but also in a very, very simplistic way to make a more efficient interactions and less expense of resources, time, traveling, and other things, that it will also result in a way into a new understanding of how activities are done in our day-to-day life. I think that's also something that companies are starting to learn, and it's just a good way to just retake all of these once we're over this crisis to new business models, more innovation, more creativity, and I don't see how this will not happen. I think the negative effects will be perceived, and we have been experiencing them already, but also the positive effects of having this opportunity to reflect and to use new resources and to better use some other resources that we already have will allow us to have new understandings and new ways to interact in the near future, and that will have an amazing positive impact, and I'm pretty sure a lot of interesting evolvements will also come out from this.
Excellent. Very encouraging words in these trying times, and especially when it comes to climate anxiety, which was our first session. I know this is a way that we can continue to work towards that, of dealing with that and working towards our goals. Our next question, which I think is a really good one because it kind of provides a critique of this industry, of this field of research. It gets at what is greenwashing, and if ESG is really a criteria that is useful, or does it really just lend more to making things pretty, making it companies seem like they're doing good around the world? What are your thoughts? Is ESG a real solution?
Well, I think that's actually something very unfortunate, and that's actually something very real. If you ask me, I think greenwashing is a terrible thing, but it does happen. It's actually very common, and I'm actually one of those people that push towards stricter, more strict measurements of these sort of impacts. But what we have in front of us is actually something very complex to measure. Environmental aspects can go all the way, as we were mentioning, from waste management to a carbon footprint, water usage, forestry depletion. We could find thousands and thousands even of criteria that we could consider. Social aspects, on the other side, also are equally as diverse. And when you also incorporate governance and other things into the picture, and then you also try not only to have all of these together, but also try to put a value into them and weighting how much any of those elements should be weighted into the equation, you end up with something very, very, very complex. It's easier to talk about financial return and just say dollars or percentages, and that's about it. You end up there. And if you want to convert dollars to yens, to euros, to Mexican pesos, that's even easy enough because there's a common understanding of how much that is compared one thing to another. But once you have social and environmental elements, just to keep it simple, sometimes social impact and environmental impact is opposing as well. So you can have elements that actually are good for society, but they're terrible for the environment, or vice versa. And when you have that kind of situation, and you also have very complex data sets that you work with, and you have other things, of course, you can always find a way to do greenwashing. And that is terrible. And I think this needs to be better structured. It needs to be regulated. As I mentioned, I think European Union, it's a little bit ahead into trying to define these things. And then in the other side of it, it's not even covering absolutely everything, because when we were talking about frameworks and talking about SDGs, we see that SDGs, for example, don't include indigenous rights, which is actually very, very relevant topic. And I think it's even a very popular topic, not only relevant, but also popular today. But it was not considered a couple of years ago when it was designing this kind of framework. So it also evolves, and it actually takes a lot of effort. What we can do as society is to be also more responsible. I mean, with more information comes more responsibility, to try to adapt that very old adage from the Greeks. We have more information now, but we also have to learn how to read that kind of information and actually know where this information is coming from, how it's being analyzed, and how we consume it also ourselves. Even with serious people that actually have their own criteria for defining ESG and other factors to be included in sustainability assessment, we see that sometimes they don't align perfectly, and they yield to different results for different measurements. It's important to be more critical and to have better frameworks, but this is just evolving. What I can say is we also are responsible for the information that we consume. And in a way, that part of our responsibility to it, it doesn't come any way different from our responsibility as consumers of financial information. Financial information today, we have many examples of companies that have been reporting things that are actually outside of legality. Some other companies that actually were saying that they were doing terrible, and still the market was not reacting fast enough to the results. We have examples of many other things, but in reality, our analysis has to include how we read the numbers that are presented to us. So in a way, I guess in short, all ESG factors are good, are evolving, are actually promoting something positive, but there's also some responsibility on our side. We cannot just ignore that we also have to be critical and have to be able to read those things. And in the final note to it, sorry to say it, but that's precisely how it is. We also have to remember that some big companies, they actually pay the bills for a lot of things. So it's just normal that they will have more optimistic views from the side of some analysts in a way, because we can find good and bad things in any multinational, and I don't want to mention names in this particular case. But of course, there's also going to be criticism on the work of analysts if they were not doing some assessment of all of the big ones. So there's also some mixed incentives there for doing a little bit of greenwashing into all of these. But yet again, it's also the case on rating agencies and how it has been for the financial world for decades. So it's just something that needs to evolve to a better understanding. Better legal frameworks and taxonomies, for example, need to be developed. And I think that taxonomy of the European Union, it's a great step ahead, and it's something that it will be replicated into other geographies or adapted in many cases. But in a way, the easy way to start is to have one good example of where it's working. And that's the first step to actually having better legal frameworks for doing it better.
Really helpful, really, really helpful. I know you said you didn't want to name and shame any organizations, but we do have two questions related to that. Where can people go to find more information on who are the top polluters? And where can people find information and data to support their arguments for using sustainable finance?
That's actually very interesting, because I actually did an exercise last year with my students in the summer school, and I showed them one of these reports. For example, there's one report that talks about banking and how the portfolios of banks, well, actually there's several reports now, not only that one that I used, but for example, showing that to my students and actually showing them their own banks and how they actually promote big oil, I don't know, like coal mining, animal rights, stuff like that. It was shocking for them. In this particular case, it was completely focused on CO2 emissions, for example. And they were just shocked. They couldn't even believe how their banks were actually sponsoring those kinds of activities, directly or indirectly. But in many cases, just holding on their own portfolios, the banks, that kind of assets. That it's actually publicly available. There's several reports available today that actually do the work of trying to find that kind of impact, and also do that precisely, name and shame who are the ones that are doing that kind of thing. I think it's part of what we need to do. We also have to be able to find those resources, be critical about the credibility of those resources, because also, as we would expect, they might be also groups of interest that might be pushing towards having research that it's misguiding. And we can find, for example, a great example of this was climate change, and how they were academic research reports saying that climate change was a reality, most of them actually, but several of them saying that climate change was a hoax. And in reality, when you go a little bit deeper and you see where the money was coming from this research, actually most of them, if not all, but most at least, were actually financed by other fossil fuel interest and other groups of interest that actually were trying to push some sort of dialogue or argument against the reality of climate change. Today, no one doubts that, but it doesn't mean that those groups of interest are not going to keep doing their own efforts and actually pushing think tanks and other organizations to develop research that can favor their own particular interest. But again, as mentioned, some of these reports are available. Look for them, check for the credibility of the sources where they come from, and you can find very, very detailed information on how some of these impacts are happening with financial institutions, big corporations, even local institutions in some cases. It's just a matter of doing a little bit of our own homework into finding those impacts.
Absolutely. The onus is on us to do those research. We won't be able to get to all of the questions, unfortunately. I do want to be able to give you guys a lunch break before we start back with our next session. So I'm going to end with this last question, which is another way for you to kind of sell what we're doing and provide some critique, because you mentioned Larry Fink, and that Larry Fink is going to change the industry, but maybe not. So the question is, Some people argue that any investment into sustainable finance will lead to a real difference for the companies because other investors will fill the gap created by these activist investors. So what do you think about that?
Well, I think you touch a very interesting point there, because I do believe the fact that Larry Fink is speaking about this, it does have a positive impact in a way. It must influence some positive change, and that's what I take from that part. If you ask me that he will be the main driver for that change, or the champion for sustainable finance, and will be the guy that actually will take that, I don't believe it either. I think BlackRock in reality will have different priorities. It's good that they now mention these as one of them, but I do believe that this takes time, and it will be reflected little by little, or perhaps a little bit faster, depending on some situations in different areas. This is a great first step, but it's only that. It's just saying it is one thing. Actually doing it, it's the most interesting part, and it does take some time and effort, and we'll have to wait to see that part. The other thing that I need to mention, to be fair here with what Larry Fink is saying, when you have almost $7 trillion on assets under management, it basically means that you invest in absolutely everything. So even though he's trying to say that social responsibility is awesome, that's great speech, but in reality, there's no way to allocate $7 trillion unless you're willing to diversify into everything. So that's also the complexity of doing this kind of change. When I talk about this in class, for example, one example that I use is renewable energy. We do see the benefits of renewable energy. We see the challenges. We have a lot of things. But then again, geographically, technologically, socially, it's very difficult to transition from one day to the other, just being totally renewable. And even if we could do it fast, it would still have pose some challenges technologically, for example, that are very difficult to overcome. In the case of financial portfolios, same thing. Some of these resistance to actually transition into sustainable finance also comes from the way that they have a business as usual that they also have to keep, and also finding the outlets for allocating all of these sustainable investments. It's not easy to find once you have such a big scope. What these kind of corporations, BlackRock being a great example of these, can do is actually advocacy. What they are responsible for and what they can actually do a lot is into promoting the idea that we need to go towards that. Why? Because as companies also start to understand that at funds, money managers, ETFs, mutual funds, retirement funds, insurance companies start to read this message more and more, then also those outlets for more sustainable investments will be created, and then more allocation into sustainable finance will be promoted. We now are on the first step trying to communicate that. Perhaps we're going a little bit further into trying to measure it, which is also an interesting approach at the moment. But still, we need more innovative approaches. We need more realistic measurements. We need better reporting. There's still some challenges that we need to take.
Excellent, and really great way to end the conversation here. Professor Vargas, I want to thank you so much for providing all of this valuable information. Our recording of the session will be made available via email, so you all can see this again. And Professor Vargas has his email there as well. Everyone, thank you so much for sticking with us. And again, thank you, Professor Vargas, for giving this presentation.
Yeah, no, thank you, Stephen, for the invitation. And also, as you mentioned, there you have my email. That's Carlos_Vargas@tech.mx. Just careful with the underscore because that's the tricky part of that email address. So if you have any questions, feel free to send me an email and I'll be happy to answer that. Some of you was mentioning B Corps and Lombard Odier, for example, that I know very well. A private bank in Switzerland. I do have interesting things that I could share with you, but again, this takes a little bit more time. This was just a brief introduction to the topic, and I appreciate Stephen for inviting me to be part of this amazing discussion. So enjoy the rest of your day, and thank you so much.
Thank you. So everyone, we are going to take about 55-minute lunch break right now. Please come back and join us at 1 p.m. We will be having an excellent conversation about how you can plan for a sustainable life. We'll have 3 really great speakers sharing about how individual investors like you and I can get directly involved with this industry and start investing in sustainable ways. I want to encourage you to check us out after the session. We'll be providing all of the links and materials. On our Eventbrite, we've provided the speaker bios, we've provided our agenda, and a Google Drive so you can have more information about what sustainable investing is. We'll have all of the presentations there as well. And then at 2 o'clock Eastern Standard Time, so 2 hours from now, we will have a networking session, which will be very, very interactive and allow you to meet other individuals virtually. I'm really looking forward to this session. So please come back, join us, and we'll see you again soon. And then the final thing is we will be opening up the next call using this same link. So you will have to leave for lunch and then you can come back using the same link. All right, everyone, have a great day, and thank you for participating in our morning session. Take care.